Have you ever wondered why some people seem to effortlessly grow their wealth while others struggle to make ends meet? What if I told you that the secret isn't just about how much money you make, but how smartly you invest it? In this video, we're going to unlock the mysteries of investing for beginners, breaking down complex concepts into simple, actionable steps. By the end, you'll have the knowledge to start your investment journey with confidence. Are you ready to discover the power of making your money work for you? Let's dive in. First, let's answer this question. What is investing? At its core, investing is the act of putting your money to work for you. Instead of simply saving your money in a low-interest bank account, investing allows you to potentially earn higher returns by purchasing assets that you expect to increase in value over time. One of the most important concepts in investing is compound interest. This is often described as interest on interest, and it's what makes investing so powerful over the long term. Here's how it works. Let's say you invest $1,000 and earn a 7% return in the first year. You now have $1,070. In the second year, you earn 7% not just on your original $1,000, but on the entire $1,070. This compounding effect can lead to exponential growth over time. To illustrate this, imagine you invest $5,000 today and add $200 every month for 30 years, earning an average annual return of 7%. After 30 years, you would have invested a total of $77,000, but your account would be worth over $283,000. That's the power of compound interest. Now that we understand the basic concept of investing, let's look at some common types of investments. Stocks. When you buy a stock, you're purchasing a small piece of ownership in a company. If the company does well, the value of your stock may increase, and you might also receive dividends, a portion of the company's profits paid out to shareholders. For example, if you bought one share of Apple stock in 2010 for about $35, by 2023, that single share would be worth over $170, not including dividends. This demonstrates the potential for significant growth in stock investments. Stocks can offer high potential returns, but they also come with higher risk. The value of stocks can be volatile, meaning they can go up and down quickly based on various factors like company performance, economic conditions, and market indicators. Bonds. Bonds are essentially loans that you make to a company or government. In return for lending them money, they agree to pay you interest over a set period and return your principal at the end of that period. For instance, if you buy a $1,000 10-year U.S. Treasury bond with a 2% coupon rate, you'll receive $20 in interest payments each year for 10 years, and then you'll get your $1,000 back at the end of the term. Bonds are generally considered less risky than stocks, but they also typically offer lower returns. They can provide a steady stream of income and can help balance out the volatility of stocks in a portfolio. Mutual funds and exchange-traded funds, or ETFs. These are investment vehicles that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. They offer an easy way for beginners to get exposure to a wide range of investments with a relatively small amount of money. For example, the Vanguard S&P 500 ETF allows you to invest in 500 of the largest U.S. companies with a single purchase. This provides instant diversification across various sectors of the U.S. economy. The main difference between mutual funds and ETFs is how they're traded. Mutual funds are priced once per day after the market closes, while ETFs can be bought and sold throughout the trading day like stocks. There are some key investment concepts that every investor should understand before making informed investment decisions and developing a long-term investment strategy. The first is diversification. You've probably heard the saying, "Don't put all your eggs in one basket." This is the essence of diversification. By spreading your investments across different types of assets, industries, and geographical regions, you can reduce your overall risk. For example, if you invest all your money in a single stock and that company performs poorly, you could lose a significant portion of your investment. But if you spread your money across many different stocks, the poor performance of one company will have less impact on your overall portfolio. A practical example of diversification might look like this. 50% in a U.S. stock market index fund, 30% in an international stock market index fund, and 20% in a bond market index fund. This simple portfolio provides exposure to thousands of companies across the globe, as well as a portion in bonds for stability. Another would be risk versus return. In investing, there's generally a trade-off between risk and return. Investments that offer the potential for higher returns, like stocks, typically come with higher risk. Lower-risk investments like government bonds generally offer lower potential returns. To illustrate, stocks have a higher risk and a potential for higher returns, historically around 7 to 10% annually over long periods. Corporate bonds have a medium risk and medium returns, historically around 3 to 6% annually. Government bonds have a lower risk and lower returns, historically around 1 to 3% annually. Your goal as an investor is to find the right balance between risk and return based on your financial goals, time, and risk tolerance. Now that we've covered the basics, let's look at 3 practical systems you can set up to start your investment journey. Number 1, the automated ETF investment system. This system leverages the power of automation and the diversification benefits of ETFs. Here's how to set it up. Open an account with a reputable online broker that offers commission-free ETF trades, for example, Fidelity, Charles Schwab, or Vanguard. Choose a broad market ETF that tracks a major index like the S&P 500. Set up automatic transfers from your bank account to your brokerage account on a regular basis, for example, monthly or bi-weekly. Start with an amount you're comfortable with, even if it's just $50 or $100 per month. Use these funds to automatically purchase shares of your chosen ETF. This system ensures you're consistently investing without having to make decisions each time. It takes advantage of dollar-cost averaging and provides broad market exposure through a single, low-cost investment. Number 2, the 3-fund portfolio system. This system, popularized by followers of Vanguard founder John Bogle, involves creating a simple, diversified portfolio using just 3 funds. Here's how to set it up. Open an account with a low-cost broker like Vanguard, Fidelity, or Charles Schwab. Invest in these 3 funds: a total U.S. stock market index fund, a total international stock market index fund, and a total bond market index fund. Determine your allocation based on your risk tolerance. A common starting point is 60% stocks, split between U.S. and international, and 40% in bonds. Rebalance your portfolio annually to maintain your chosen allocation. This system provides broad diversification across domestic stocks, international stocks, and bonds. It's simple to set up and maintain, and it uses low-cost index funds which have been shown to outperform most actively managed funds over the long term. Number 3 would be the robo-advisor system. For those who want a completely hands-off approach, robo-advisors offer an excellent solution. Here's how to set it up. Choose a reputable robo-advisor platform, for example, Betterment, Wealthfront, or Vanguard Digital Advisor. Answer some questions about your financial goals, time horizon, and risk tolerance. The robo-advisor will create and manage a diversified portfolio for you, typically using a mix of low-cost ETFs. Set up automatic contributions to your account, starting with whatever amount you're comfortable with. For example, if you use Betterment and indicate that you have a moderate risk tolerance and a 10-year investment horizon, they might create a portfolio for you that looks something like this: 45% in U.S. stocks, 35% in international stocks, and 20% in bonds. The exact allocation will depend on your specific inputs. Robo-advisors use advanced algorithms to create and manage a diversified portfolio tailored to your specific needs. They handle all the complex tasks, making it an ideal solution for beginners who want professional management without high fees. As you start your investment journey, keep these important points in mind. Start early. The earlier you start investing, the more time your money has to grow through compound interest. Even if you can only invest a small amount, starting early can make a significant difference over the long term. For example, if you start investing $200 per month at age 25, assuming a 7% annual return, you'd have about $525,000 by age 65. But if you wait until age 35 to start, you'd only have about $244,000. That 10-year difference results in more than double the final amount. Think long-term. The stock market can be volatile in the short term, but historically, it has trended upward over long periods. Try to ignore short-term market fluctuations and focus on your long-term goals. Understand your risk tolerance. Only invest in a way that allows you to sleep at night. If market fluctuations are causing you significant stress, you may need to adjust your portfolio to include more conservative investments. Continue learning. As you become more comfortable with investing, you can explore more advanced strategies and potentially adjust your approach. But for now, focus on getting started, staying consistent, and thinking long-term. Your future self will thank you for the smart financial decisions you're making today. This is Aaron from My Personal Finances. Thanks for listening, and don't forget to like and subscribe.